Good afternoon, students. We welcome you all to this fortnight program organized by Board of Studies Academic of ICAI to unlock success through clarity, strategy, and confidence. This program is for CA Intermediate course students appearing in September 2026 examinations. And so far in this program, we have covered 5 papers. And today in this session, we will be covering paper 6A, Financial Management. The session would be taken by CA Jagabandhu Padi, and he's our subject faculty, and by Dr. N.N. Sengupta, our BOS faculty. Both the faculties have already joined with us. We welcome you, Sengupta sir and Jagabandhu sir, for this session. And students, as we have been doing in our earlier sessions, today also in this session, the faculties would be covering certain important aspects and topics from this paper. And they will also help you understand how to avoid some of the common mistakes. And the faculties would also be taking the queries which have been submitted by you during the session. They will be taking those queries. So we request you all to please take note of all these valuable, very important points which the faculties would be sharing with you. You would find it very useful for your exam preparation. And we also have one more request to make to all the students. At the conclusion of each session, please do fill the feedback form which is being sent to you. The filled in forms really help us to understand your learning needs. So please do fill the feedback form. So with this, I hand over the session to Sengupta sir and Jagabandhu sir. Over to you, please.
Thank you, S. Rita ma'am. Thank you for your nice introduction and giving the brief that what exactly we are going to cover. And thank you, CA Jagabandhu sir, for joining us. You are always helping the students in various topics of financial management and taking their queries, solving their concept. And most importantly, all the students, welcome to this session organized by Board of Studies Academic. So this is the paper of Group 2 and 6A, and it's with the combination of strategic management. Most importantly, this is the second paper of this group, which is numerical based or conceptual based, except the cost and management accounting. And you can score heavily if you prepare very, very well. You can score well in this particular segment of the subject, which is of 50 marks, because we know that sometimes we struggle to score high marks in auditing. So this paper may compensate that. It's not that you cannot score high in auditing, but obviously the probability of scoring high is much more when the numerical papers are there. It may be any subject. Now, coming to this particular subject, I may tell you that the syllabus has been divided into 4 segments. So, you should be knowing exactly what you are studying, what is the concept behind it. Now, first part, there is introduction to the financial management and ratio analysis. Then the second part is the financing decision. So if you talk about the first chapter, you will come to know that there are 3 finance functions. Finance function are 3. First is financing decision. So in the financing decision, we cover capital structure and we cover leverage. Now, what we cover in capital structure, we cover net income approach, NOI approach, traditional approach, and Modigliani-Miller approach. And then we discuss the relationship between EBIT and EPS. What are the different situations? What kind of situation will increase the earning per share? Then we talk about leverage. There are 3 kinds of leverage we talk about. One is operating leverage, financial leverage, and the combination of 2, which is known as combined leverage. So that's part of the financing decision. Now the second part is the investment decision. In the investment decision, when you talk about that where to invest, how to invest, there are various evaluation techniques we apply. Now, without taking the present value of money, we take two techniques. One is payback and accounting rate of return. And with the application of present value, we talk about net present value, that is NPV. We talk about IRR, internal rate of return, the rate at which your NPV will be zero, and then profitability index. Okay. Payback obviously also can be done with the help of present value of money. Then the dividend decision. It's not only the earning money, but finance also deals that how much to be given and how much to be retained. Why to be given? Because your equity shareholders, your investors, they are investing money in your organization. So you need to give dividend to them. And why to retain? If you don't retain the money, you cannot reinvest it. And if you cannot reinvest it, you cannot have growth. So how growth is calculated? It is the return on the retention of money. Okay. So when you are having the return on the retention of money, then only you will have growth. In popular term, it is known as G. So G means financial management. Then we talk about the short-term management, which is the lifeblood of business, working capital management. Because you need to work on day-to-day expenditure, day-to-day operating things. Now, operating capital in technical terms, it is net working capital, that is current asset minus current liability. But it is important to know that how much fund I am deploying on my current asset, which will be there on hold for certain period of time. Working capital, four aspects. There are many aspects, four aspects you need to work upon very, very carefully. Number one, you need to talk about the working cycle, working capital cycle. In popular terms, it is known as operating cycle. Okay, so raw material, from raw material, it goes to WIP, WIP to finished goods to debtor, debtor to cash. So conversion of cash to cash through various phases, through raw material, WIP, finished goods, then selling. Selling can be two types. One is cash selling, one is credit selling. So this is operating cycle. Second part is, what is your working capital requirement based on your deployment of your fund in the current asset and maybe current liability. So requirement of plus some contingency you can take. Third, and I believe one of the most important part is, because in industry, almost all sales are credit sale. In real life business, almost all sales are credit sale. And if you cannot manage your credit sale properly, then you cannot stand anywhere. So credit management is very, very important from perspective of business. Now, for credit management, you need to understand various aspects of receivable management. So what are the benefits if you extend the credit period? What is the disadvantage if you extend to that? Sales may increase, bad debt may increase. So what is the permutation combination? What ultimately is going to be net benefit to me that I need to evaluate? Then sometime the recovery of credit may be difficult from the business point of view. So we appoint factor. So factoring, we need to pay them commission. There are certain other aspects we need to take into consideration. So another very, very end. So receivable management, one is the straightforward one, another is with the factoring. And I will request you to consider both as important. And then obviously cash management or model, Bauman model is there. You need to think that how you can manage the cash effectively for an organization. Maximum possible bank finance is also there at the end. But these four aspects are very, very important. There is credit management also, payable management, better to say. But main aspect, if you talk about, is your operating cycle, your working capital cycle or working capital requirement. Then the third is your receivable management and factoring. Factoring, I'm keeping little separate from the receivable management because that requires a little bit more understanding. There are concepts which is given in the study material. There are formats which is given in the study material. There are number of questions which is given in the study material in all this chapter. One I have not discussed with you is ratio analysis. Now, ratio analysis, I got some query. Sir, Jagabandhu sir is a master of ratio analysis. I got certain query that how to mug up the formulas. Please don't do it. You only need to understand the concepts. When we are talking about solvency ratio, you understand that I am trying to understand the solvency of an organization. Okay. When I'm trying to understand the liquidity, you think about that what are the ratio which will measure the liquidity. Okay. Like in the human body, we all do the testing of our blood. How much hemoglobin is there? How much is the ESR? How much is the RBC? How much is the WBC? How much is the platelet? That will tell us a specific ratio. Anybody I am suspecting he may have typhoid. So maybe I will go for type E. I may suspect somebody is having cholesterol. So I may ask to go for lipid profile. So ratio analysis, whatever you want to test, whatever health you want to test of an organization, financial health, then you can apply that. Obviously, there are certain limitation industry-wise, it can vary. And also there are certain queries I have seen that, sir, do you think that current ratio should be 2:1 everywhere? No, it's an ideal ratio, but industry-wise it will vary. Current asset, for an example, inventory. Let's say I'm talking about a winter jacket company, let's say Jalandhar-based company who manufacture winter jackets. Their WIP will be much higher in the winter period, seasonal fluctuation. Are you getting my point? Or they may be, starting their production little earlier, so their WIP will be very high. Their finished goods will be very high. They will keep it and then they will sell it. Now, one of the organization, for an example, one of the car manufacturing organization, I'm not naming it, in India, very popular car manufacturing organization. In 2012, they launched one particular model where their inventory was very high. All the inventory was lying somewhere. Probably our Jagabandhu sir is staying in Mumbai. So when that kind of inventory is there, that means what? When high inventory is there, that means it is not moving. Your inventory is not getting converted into sales. So when your inventory is high, your current asset will be appearing high, but that doesn't mean that you are doing well. Okay, so all these factors need to be taken into consideration in ratio analysis. And the last one is the cost of capital. So when you are talking about the cost of capital, first please understand what are the sources of finance. You understand cost of debt, pre-tax, after tax. Then you understand cost of redeemable debt. Then you understand preference share, cost of redeemable preference share. Then you understand cost of equity. What are the technique we can apply for calculating cost of equity? CAPM is one of the major technique. Then earning price ratio, realization yield, dividend yield, and then retained earning, cost of retained earning. Though retained earning is our own money, but we take the opportunity cost of that. And please remember, personal tax is no longer applicable. So we have removed from the study material. So even in the question it is given, you please ignore that. So this is the overall picture of financial management. I have taken one question paper, full question paper, and question wise I will tell you that where you go wrong, quoting the exact figure where you can go wrong or you generally go wrong and how you can remove those areas. Okay, so that I will come afterwards. Now I'll request Jagabandhu sir to kindly proceed with your thought process and share your wisdom and knowledge for the students so that they do well in the examination. Also, they understand the subject well, because this is again a conceptual paper, and when their concept will be clear, then only they will do well in this subject. Sir, over to you. And thank you, ma'am, once again.
Thank you, Sengupta sir, for the opportunity to guide our beloved students towards their exams. It's really interesting to interact with them when the exams are around the corner, because a lot of students might be getting multiple questions with regard to subject. Even though they might have already studied the material, they might have solved questions, they might be in a position to address questions, but somewhere or the other, when they are solving the paper, many questions just pop up in their mind as to, they're in a dilemma. Is it really correct, whatever I'm doing? Is the formula correctly applied? Am I taking the numbers correctly? So I would like to address those very much part in our discussion, where the students would be getting stuck up while solving the papers, especially. And also, we'll be obviously having an overview of what is the syllabus and what the syllabus expects from the students to be knowing. You have rightly started the discussion by saying that ratios need not be mugged up, because the moment you start with the point of mugging up the ratios, then it's game over for the ratio analysis chapter. Because then you'll start getting confused. What's the numerator? What's the denominator? Whether it's a percentage, whether it's actually a ratio. So those all things are quite common when we are looking at the subject. So let me just begin the discussion by looking at which are the areas in ratio analysis where students can really make mistake. And somewhere there is an underlying assumptions with regards to the question, which are quite common sense, but then still we sometimes the student get confused due to the exam pressure. So beginning with the ratio analysis, I think Sengupta sir has done a fantastic job by introducing the syllabus to you initially. So let me just take up the ratio analysis discussion points where the students get stuck up. The type of questions which we find in our study material and also in the past exam papers, we say we have like questions where we need to calculate the ratios directly. Right? So you have certain balance sheet and P&L numbers and you need to calculate the ratios. So those part is pretty easy enough. But before you go ahead with the calculation of ratios, students needs to be very clear, what parts of balance sheet or P&L are included in the ratio. Okay. So for example, if we say operating profit ratio, so when I say that we have to calculate, let's say operating profit ratio. So normally the formula we say is operating profit ratio is simply going to be operating profit upon sales into 100. But then the question students have is, sir, what do you mean by operating profit? Right. So what do you mean by operating profit? So obviously we should be very clear that operating profit is nothing but your earnings before interest and tax. Right? So it has to be earnings before interest and tax upon sales into 100. So certain ratios you need to be very clear when you're calculating these numbers. So just like operating profit, one more ratio where students get confused most often is called as an operating ratio. Now this is ratio, sometimes students feel that we can remember the ratios just by looking at the name, but that's not true. You need to be really conceptually clear to get the answers for these ratios. So when you say operating ratio, students, what do you think about operating ratio? Is it same as your operating profit ratio? No, right? It's not same as your operating profit ratio. Operating ratio, you should, whenever I teach you, you understand that. I tell you that this is the ratio which tells you what proportion of your revenue you're actually putting in for running your business, for operating your business. So what expenses do you really incur when you want to run your business? The most common thing is your cost of goods sold, because that's the biggest operating expense which you have, COGS, right? Over and above that, you're just not doing things in the factory and the godown. Your business doesn't mean whatever is getting manufactured in the factory, whatever is being stored or being traded in the godown, that's what your business is. No, that's your cost of goods sold. Apart from that, we have other operating expenses also. So whenever it's operating ratio, make sure you remember that it's going to be cost of goods sold plus the operating expenses which are there, which are happening in your office also. So which are those items which we have in our office, which is the over and above that, of course, we have the admin expense and most importantly, selling and distribution expense. Okay, so this is the ratio where you typically face difficulty, where students find it quite confusing regarding the operating ratio. Another ratio students find it difficult or not so easy to remember is interest coverage ratio and debt service coverage ratio. Now, interest coverage ratio, students, you're able to understand is since it is interest coverage, you're looking at EBIT upon interest, because you're saying that we need EBIT to earn to pay interest. So you simply take it as earnings before interest and tax upon interest. But when it comes to DSCR, debt service coverage ratio, then students start thinking what will be the numerator. If it is debt, then should it be only the interest or the principal? So understand interest coverage, it is simply telling you what you need to earn for paying the interest. Debt service coverage is definitely going to be telling you what you need to pay the interest as well as the principal. So of course, in the denominator, you have interest plus the principal that needs to be paid. Okay. And in numerator, we are not going to focus only on EBIT. Because remember, earnings before interest and tax, it's a P&L figure. It's not a cash flow figure. So we need to have an item in the numerator, which will be essentially reflecting the cash that the company is generating. So apart from this EBIT, what we do is, through that EBIT, we add back the depreciation and amortization, right? And also any non-recurring expenses which we have. If you are having any non-recurring expense or income, that needs to be adjusted over. So remember, when you want to pay principal, you can't pay principal, or for that case, interest also, just with your P&L, because your P&L is just an accrual basis. But when you want to pay your loan, you need to actually transfer money from your bank account to the banker's account. So for that, you need to know what is the cash flow that is being generated. So please be sure that debt service coverage ratio, numerator, it's not going to be only EBIT. Okay. Apart from that, the ratio where students sometimes get stuck is capital gearing ratio. Okay. So capital gearing ratio, they sometimes compare it with debt equity. Now, debt equity is borrowed funds in the numerator and equity funds or own funds in the denominator. But capital gearing ratio is one step ahead of that. It just thinks, or it just gives a different dimension in the form that apart from the debt which the company is facing, company also needs to pay certain fixed obligation, and that fixed obligation, which is financial in nature, is essentially your preference dividend. So capital gearing ratio, it doesn't talk about numerator debt, denominator equity. It simply says that in the numerator, you should have funds which require a fixed rate of return. Okay, so capital gearing ratio is like funds which require a fixed return in the numerator, and denominator will be funds without any fixed return. So when a company is raising money, it is obviously going to promise certain return. It's obviously going to strive to earn certain return for its investors, and those investors can be your equity, debt, or preference. Wherever the company has promised to pay a fixed return, that goes into the numerator. So obviously, whatever borrowed funds we have, that comes in the numerator. But apart from that, you're also promising fixed return to the preference shareholders, which is essentially a preference share capital, right? And then you just take in the denominator only those funds which do not require any fixed return. And those funds are your equity share capital and the reserves, right? So this is one ratio where you get confused, why preference share is there in the numerator. Because the logic is preference share capital is something where you need to pay a fixed rate of return. Okay, so that is like a debt for you, right? And I'm pretty sure when you are, getting to the final level, you will get this ratio in a more contextual way, because there you will learn good amount of accounting standards, which will change everything what you might be imagining about the real prospects. Okay, so there you will really get the crux of this ratio, why we are taking the preference share capital in the numerator. For the time being, let us understand that preference share capital require a fixed rate of return, so it needs to be put in the numerator. Okay, one very important aspect is, I would like to give this trick to you students. Sometimes students ask that which ratios are to be written as percentage and which ratio should be written as like a ratio normally. See, the very simple way to understand this is, wherever it is a rate of return, wherever we are talking of any rate of return, whether it is return on equity, whether it is return on capital employed, whether it is return on owned funds, right? So all those things, can I express in terms of ratio? Will any layman understand that, see, my return on equity is 0.45? Of course, return on equity of 0.45, we as finance professionals, we can obviously understand, okay, 0.45 means 45%. But see, the output of this ratio analysis should be that, normally, medium case educated individual would also understand the numbers. So whenever you talk something, what is the rate of return? Anyone would say in terms of percentage. So whenever it is a rate of return, always remember it's going to be expressed in percentage. Okay, that's one thing. Okay. So in percentage form, which are the ratios? The first ratio that I said is all your rate of return. Okay. Secondly, all your P&L ratios, gross profit, net profit, operating profit ratio, EBIT ratio, all those are always going to be expressed in terms of percentage. So all your P&L ratios, they're going to be expressed in terms of percentage. But don't make it a common thing that, let's say, if our GP ratio is given as 0.4, and then you say, sir, is it 0.4%? No, don't be, that very much naive to understand, because if you say GP ratio is 0.4 and there's no percentage sign over here, don't presume that it is 0.4%. Okay, when you're writing down the answers, definitely if you're getting, 40 divided by 100 into 100, of course, you can say 40%. But wherever you see like any P&L ratio is expressed as 0.4, 0.6, understand that unless and until there is a percentage sign, don't assume it to be 0.4% or 0.9% or 0.7%. Okay, so these are the two areas where we can definitely say in common parlance that these are going to be expressed in terms of percentage. Okay, that is one thing. One more common query which student asked us, sir, where do we take, in which ratio should we be taking directly the item from balance sheet and P&L, and in which ratios we should be taking the average? That's a very common question which students ask. Sir, in certain ratios, we just have the balance sheet and P&L number. For example, we say debt equity ratio. So you say it is debt which is borrowed funds in numerator and equity in the denominator. So you say you're taking the balance sheet figure. But in certain ratios, you're asking us to take average equity shareholders fund or average assets. How do we try to distinguish between them? The common rule for that is you have to simply follow your accounting concept, matching principle. Any ratio in which one of the numbers is representing the full year, you can't have the other number which is representing just the year end. Right? For example, if we say debtors turnover ratio. So debtors turnover ratio. Now, we know the formula for debtors turnover is credit sales upon debtors. Now, the common sense formula says this sales, is it representing of only what has happened on the last day of the year? No, this is representing the full year. This is representing the full year, right? So how can I have the closing debtors over here? So as a ratio, you will say, sir, sales numerator is representing the full year. The denominator should also be representing the full year. So how do I represent now full year? Because I just have the debtors balance in my P&L at the year end. So how do I represent it full year? So ideal way would be take the value of debtor in the first day, take the value of debtor in the second day, take the value of debtor on the third day, take the value of debtor on the fourth day. Same way, take the value of debtors till 365 day, which is representing full year, and then you take the average. This is the ideal way. But of course, we don't have so much of data, and neither do we have time to calculate all those 365 numbers total and then take average. So therefore, what we simply follow is take the average of opening and closing figures. So all your ratios, wherever, remember, as a rule, if one of the part of your ratios is coming from P&L, another part is coming from the balance sheet. Of course, balance sheet figures are representing the year-end figures, but P&L figures are representing the full year operation. So in that situation, you have to take the average. If the average information is available. Like if you have opening information available with you. If there is no information regarding opening figures are available, then of course we can definitely take the closing figures, and those closing figures are going to be representing the full year figure. Okay, so just be cautious of that part. The simple rule to think about taking of averages is one of the figures in your balance sheet, in your ratio is coming from P&L. Another figure is coming from balance sheet. So whatever figure is coming from the balance sheet, ensure you take a average of that if the data is available. If the data is not available, we can very well assume that the opening figure is same as the closing figure. So average is also same. Okay. One important aspect which students actually fail to focus when it comes to ratio analysis is to how to solve those questions where the ratios are given and we have to prepare balance sheet or P&L, right? So most of the students actually tend to connect the dots, use the ratios and numbers and solve it. But I want to give two tips over here when you want to solve these questions of balance sheet or profit P&L formation from ratios. The first is the starter pack. Sir, how do I start the question? Now, when you are starting the question for any balance sheet or P&L type reverse question, always look for any absolute value which is expressed in rupee terms. Maybe the value of fixed asset, maybe the value of equity share capital, maybe the value of debtors, maybe the value of somewhere or the other. At least one value will be given to you which will be expressed in terms of rupee. Because unless and until you have something in terms of rupee, you can't create the balance sheet and P&L out of only ratios and percentages. So always look for that figure, right? So if, for example, if the question has given you, let's say, value of fixed asset, there will be definitely a ratio which will be connected with fixed, which will be connected with the fixed asset. Maybe a fixed asset turnover ratio, maybe fixed asset to equity ratio, maybe fixed asset to current asset ratio. Take that number, take the value which is expressed in rupee terms, use it with the ratio, and then start solving it like a puzzle. You start with one number, you get the second one, you put the second in the given ratio, you get the third number. So it keeps on unwinding on itself, right? So starter point is somewhere where the students get confused. Sir, all these ratios are given. How do I calculate this? The simple is just look for a number which is expressed in rupee terms, and secondly, look for the ratio which is connected with that, and then start unwinding the entire question. That's point number one. Second point is sometimes students get stuck, sir. We have prepared the pro forma balance sheet. We have fixed asset, current asset, let's say owned funds and borrowed funds. Okay. We have filled up this, fund, right? But we don't know both these items. We don't know what is fixed asset, what is owned funds. Okay. And there is some ratio given to you for owned funds to fixed assets. Now, this is where students start feeling, tricky, sir. How do I solve this? The balance sheet is, two things are unknown. Now, of course, if there are two things unknown, there will be two simultaneous equations given to you. That's the rule of mathematics. If you have two things unknown, there has to be two simultaneous form of information given to you. One, obviously, you can say, sir, there is some ratio between fixed asset and owned funds. That's one thing. So where is the second thing? Second thing is simple, the balance sheet itself. Because in the balance sheet, we know total of assets should be equal to total of liabilities. So if you're stuck somewhere, where you have two things unknown and you just have one ratio between them, then of course, one information is regarding the ratio, and make the information, make the help of the simple balance sheet equation that total of assets should be equal to total of all your liabilities. Okay. So this is what, tips and tricks or the mechanics of ratio analysis is. One more important aspect which I want to highlight with when it comes to ratio is, ratio is not about just calculating ratios or preparing balance sheet or P&L in a reverse questions. It goes one step ahead with ratio analysis, because name of the chapter is ratio analysis. Name of chapter is not calculation of ratios. Name of chapter is not preparation of balance sheet using ratios. The name is ratio analysis. So every ratio that you calculate, you need to be a doctor in that. You need to be a specialist doctor in that. What is that ratio denoting? How do I identify whether the company is in problem from that ratio or the company is really doing good in that ratio? So that interpretation need not be skipped at any point of time. Okay. Last but not the least, the topic of ratio to which students give the least importance, or maybe they just skip those 2 pages, maybe that is regarding the DuPont analysis. Students, this DuPont analysis, you might have heard it earlier. This was actually started way back by a French company, and it was really appreciated by its shareholders for preparing the financial statements in the DuPont form. And that became like a syllabus. It's very few cases that you observe that the company's voluntary practices start becoming gold standard of practice of financial reporting. So that was DuPont analysis, and obviously at inter-level we have very limited level of DuPont analysis part. When you really start working into practice, you will realize that DuPont analysis is used extensively when you are going to carry out any ratio analysis for a company. So don't skip that part, because DuPont analysis is also a part of your ratio analysis. It's a very much an inherent part of a ratio analysis when you're carrying out the analysis of the companies, because that helps you identify which are the areas where company needs improvement. Okay, so don't skip that part. That is relevant. And actually, once you understand DuPont, it will enhance your understanding of all other ratios also. Okay, so that is about ratio analysis topic, which I would like to highlight. Now, let me just take it forward with the next topic, which is leverages. Now, the topic of leverages, we know it's purely.
Sir,
Yes, sir.
Jagbandhu sir, a few questions of ratio. Let me answer those queries right now. One, obviously, how to remember the formulas. Already, sir has pointed out. I have also spoken in the earlier that you should develop your conceptual understanding about each and every ratio. That will really help you. And there are certain ratios which can be created automatically. For an example, let's say sales to asset. For an example, okay. So there are certain ratios where the numerator and denominator is already given. Whatever is there in the question or whatever we are trying to calculate. Rest, conceptual understanding should be good. And obviously there are certain little tricky ratios. Sir has covered two very important, debt service coverage ratio is one of the most, what I will say, some most difficult I can say, or sometimes difficult to remember, and capital gearing ratio. Interest coverage ratio is another. So these are some of the ratio maybe you will be able to, and when you solve problem, this will stick into your mind. But I don't think you should be preparing a chart and mugging up current ratio. Everybody, if you solve few question, you will note that current ratio means current asset by current liability. So that is one thing. Second question was that what kind of question comes in ratio analysis? Obviously, two categories generally we see. One is calculation of ratios and interpretation, because it's not to calculation, sir has pointed out. Interpretation, what does it mean? Whether it is good or bad. And second is obviously preparation of the financial statement from the ratio. So both type of question we see in the ratio analysis. There may be another type of or any other type of question in ratio analysis as well. So these are the two questions related to ratio analysis. And leverage, obviously there is one question. So when you will cover that, I will answer that query, sir. Sir, kindly carry on, please. Unmute, please.
Just ratio after ratio, the next analysis happens is with regards to the leverages. And again, leverages is like one of the very favorite topics for students, because they say, sir, It's a very small topic. It's just based on 3 or 4 formula, and then we are done. Definitely, yes, it's a easy topic and quite simple to score. But one common area where students actually make a mistake is the calculation of financial leverage. So if I ask any random student, how do you calculate financial leverage? Even after clearing out the CA Inter exams, they normally say, sir, financial leverage, it is very easy. It's just EBIT upon PBT, that's it. And that simple ratio is actually stuck into the minds of the students that financial, so it's like, we have the operating leverage as, it is simply your contribution upon EBIT. Then you have the financial leverage as EBIT upon PBT. And then you have the combined leverage as contribution upon profit before tax. So they normally remember that, okay, between contribution and EBIT, you have the operating fixed cost. So these two are the numbers. Financial leverage interest is the only fixed cost, and then combined leverage is calculated. But then one common thing is this particular ratio or this particular formula of financial leverage is not applicable in a one special situation. And that special situation is financial leverage when a company has got preference dividend. This formula is not going to work over there because your financial obligation, your fixed financial obligation doesn't end over here at PBT.
This time only there was a question where
Okay.
preference was included. Yes, carry on, sir.
Yeah. So, we find that students normally use this formula without giving due regards to the, financial leverage, that we may have something different also. So remember that financial leverage is not EBIT upon PBT. It's EBIT upon PBT minus preference dividend upon 1 minus T. So we make this preference dividend before tax. Now the logic is simple. If you're supposed to be paying 7 rupees preference dividend and 30% is the tax, you need to earn 10 rupee to pay 7 rupee dividend. So your obligation is not to earn 7 now. Your obligation is to earn 10. So that pre-tax thing is taken care over here. So just be sure that this particular formula is taken into account when you're calculating financial leverage. And sometimes, when we ask the students to please verify your answer, so they initially calculate financial leverage using this. But then when they're looking for percentage change, like 10% change in EBIT is leading to how much change in the EPS, that's where they get stuck. So they say, sir, now, sir, how to do? Because the problem is the answers are not matching. Obviously, the answers is not going to match because the formula that you have used is incorrect. Okay. So that's one thing which I want to highlight about the leverages. Second thing is, when we are also looking for leverages, we also find that leverages are such type of questions also we have when we have to prepare the income statement from leverages. Okay. So those type of questions students need to be careful of, right? And there also, again, it's like a puzzle. You just solve it for one and then rest all values automatically follows. Okay, rest all values, they just start following automatically. One common understanding that students need to have is all these ratios or all these leverages are essentially a measure of risk that the company has undertaken. So if it's like operating leverage, it's the operating risk which the company has undertaken. So it indicates that how much obligated the company is to recover that fixed cost which it is incurring. Of course, that fixed cost is recovered by company through contribution, right? So higher operating leverage indicates operating risk. Higher financial leverage indicates higher financial risk. Okay. So what is the purpose? You need to understand what's the purpose of calculating operating, financial, and combined leverage. Okay. So when you're looking for risk comparison from one company to another, investors' perception of company's value depends on the risk that it has undertaken. A company which is having a higher degree of risk in its financial statements, obviously investors are going to perceive that company with great caution. They'll not easily invest in that company. And even if they're investing, they will be asking for a high rate of return. So to measure that level of risk is the purpose of to calculate the leverage. Okay. So, of course, at inter level, we don't have, one step ahead of leverages. But when you go into practice students, then you will realize that these leverage numbers are essentially used when you are forecasting when the company can go for default. These numbers are really relevant if for introducing into the models where you want to see whether the company can default. Can a company default on its loan? Can a company really go bankrupt? And in how much time? So we do have advanced models. That's for your obviously your career prospect. But when it comes to your examination point of view, be very sure that these leverage, or in fact, I can say ratio and leverage, both are under a group of chapters called as financial analysis. So again, I would like to highlight these numbers or ratios or leverages are not meant for only calculation. You need to know the interpretation of that. Okay. So to simply understand that, they represent like some elasticity of demand thing. But then definitely these are one step ahead to calculate the ratios or calculate the risk that the company is undertaking. Always remember, sometimes you might have also come across one or two questions which I can recollect, where you are comparing these ratios with the company's beta numbers. Okay. So their students generally ask, sir, how is the company's operating leverage and financial connected with the beta? Because see, beta is calculated as a perception of the company's risk in the market. Obviously, that risk is going to get influenced how the company is managing its business and how the company is financing it. So normally you will find that a company with high combined leverage is going to face higher beta numbers also. Okay. And one more, obviously, all these operating financial leverage and combined leverage, they all are ratios. They are not percentage, because I have set a rule for percentage. It has to be the returns or it has to be the P&L numbers. Okay. So, Sen Gupta sir, any queries specific with regards to leverages?
Yeah. So they were telling that how to handle a new adjustment in the chapter of leverage. I think new adjustment, one of the adjustment which sir told that when there will be preference, a dividend, that adjustment you need to be very, very careful, because one that comes, it does not become that equation. Otherwise, you prepare your income statement. I think that's the easiest way you can go. Sales minus variable cost, contribution minus fixed cost, EBIT, then less interest. Then obviously you need to reduce the tax and divided by number of share. That will become EPS. And financial leverage will be EBIT by EBT. But if there is preference dividend, then what sir has told, you need to follow that. Operating leverage, contribution by EBT, and combined leverage, contribution by PBT or EBT. In every cases, leverage basically talks about that how much leverage we are getting on the fixed cost. Because fixed cost is there in between. If you talk about contribution by EBT, EBIT, then fixed cost is there. If you talk about financial leverage, EBIT and EBT, then there is interest, which is another fixed cost as such. And then fixed cost plus the normal fixed cost or interest, both combined together will become the combined leverage. And similarly, when you talk about the degree of combined leverage, degree of financial leverage, and degree of operating leverage, so degree of operating leverage will be telling you, changes in EBIT and changes in sale. Then the financial leverage will tell you changes in EPS, and combined leverage will tell changes in EPS and changes in sales. So in this way, you need to understand, one is the calculation of leverage, another is the degree of operating leverage, financial leverage, or operating leverage, which is the measurement of the changes. And one very important word which sir has used is that leverage is basically measuring the business risk of an organization. We do not understand that much in depth probably at this level, and the chapter is very small, the concept is very small, but it is having a lot of significance. Because when you are talking about financial leverage, for an example, it will change with the kind of debt you are taking. So it will signify, all three, this leverage will signify the kind of risk you are assuming, or you are taking, or your business is taking. So from that perspective, also financial leverage is very, very important. So adjustment, I think this is one of the adjustment which you need to take into consideration. Tax part, you see that what tax percentage is given, that probably another one. And also try to see whether they are asking simply to calculate leverage, or they are asking to calculate, the examiner is asking to calculate the degree of operating leverage, financial leverage, combined leverage. Sometime interchangeably, these two also can be used. So it should be very, very clear. I don't think there is any other tricky adjustment as such in financial leverage. Very straightforward chapter. You need to be, very, very careful about calculation, practice, and various information which is given, and be careful about the preference, because once preference come into play, the whole income statement will go for a toss, and there will be changes in calculation of financial leverage. I think, sir, if you want to add anything, I think this is probably we can do. Otherwise, I don't think there is any tricky adjustment as such in case of leverage chapter.
So leverages is quite straightforward because there's no manipulation involved in it. So there's no tricky adjustment into it apart from this one or two. Okay, so I think let's go for the next chapter discussion then, which is a really interesting chapter called as the cost of capital. So when it comes to cost of capital, understand the intention of the chapter, students. Our intention.
Sir, before you go, pardon. There was one question in the last question paper in the May 2026 question paper of leverage, question 1A, and many of the candidates could not, many of the students could not calculate the current level of sales accurately. So, base figure of the questions you need to calculate first. So you need to calculate the current level of sale there. And then when your current level of sale you are unable to calculate, or you are unable to calculate correctly, then balance things will go wrong. Okay, so this is question A. I will just read out the question. Finance manager of A Limited noticed a 5% increase in sale leads to increase of 9,000 in operating profit. The company operates with a contribution margin of 40%, fixed annual operating cost of 1,35,000, and interest obligation of 30,000. So first you calculate the existing level of sale, and very easily after that you can calculate the operating leverage, financial leverage, and combined leverage. So this much understanding you should have. Carry on, sir, please.
Let's go for looking for the cost of capital now. The intention of this chapter is to understand that this cost of capital needs to be computed. The question should be asked, why do we need to calculate the cost of capital? So when you have the answer to this why, you will understand what's the expectation from this particular chapter. So obviously the why thing is we are raising capital from multiple sources: debt, equity, preference share, retained earnings, and then you invest that money into the projects. So the idea is you want to know how much return I should be earning on the funds so that I give returns to the finances or to the investors. So I'll be looking for projects which are sufficient enough to provide returns adequate for my investors. So I want to know what is the return that is expected by each of my investors. And for that, we do have the cost of debt calculation formula. So cost of debt, we know we have got two set of formulae. One is for redeemable and another is for irredeemable. So for redeemable, we know it is interest into 1 minus T plus redemption value minus net proceeds upon number of years. And then the whole thing is divided by redemption value plus net proceeds by 2. This is essentially how you calculate the cost of debt. Okay. Now in this, certain important aspects is this interest number is anyways a percentage going to be with the multiplied by the face value. With regards to redemption value, so what should we take the redemption value if the question is silent? Of course, the question will be giving you the face value. So if the question is not giving any information with regards to redemption value, you can definitely take the face value as a redemption value. Then what should be the net proceeds? Now understand, net proceeds reflects the money that you receive in your account on issuing these debentures. So what is the money that you're going to issue? You are going to receive. You're going to receive, of course, the issue price at whatever price you're going to issue the debentures. Subtract any amount of flotation cost or issue expenses which are incurring. So flotation cost can be your stamp duty fees, your processing fees, your SEBI fees. So all those fees needs to be subtracted from the issue price to arrive at the net proceeds. So to arrive at the net proceeds, we need to subtract all of that. Now, in some cases, market price of shares are given. So can we take market price of the share as net proceeds? Yes, because you can obviously say you're going to receive that market price if you issue the shares, if you issue the debentures today. But then remember, if there is a flotation cost applicable, you need to adjust for that also. You need to subtract that also, because otherwise the whole idea of calculation of this cost of capital goes for a toss. Okay, and n obviously has to be the number of years. So remember, this formula is pretty easy to implement. Sometimes it can be confusing unless and until you are having that conceptual clarity. Okay, so that is with regards to the redeemable. Now, if it is irredeemable, so how do we know if it is irredeemable? First up, the question is not telling you when the debentures are going to be redeemed. So it is quite obvious it is irredeemable. So cost of debt for irredeemable, it's going to be interest into 1 minus t upon net proceeds. Simple. And all these numbers, cost of any cost of capital is always going to be percentage. Okay. Now, obviously, the cost of preference share is also on the similar lines, where you have instead of interest, you have the preference dividend number. Okay. There's no dividend distribution tax or personal tax that's applicable. So it's just going to be preference dividend plus redemption value minus net proceeds upon n, the whole divided by redemption value plus net proceeds by 2. Okay. Tricky part in cost of capital comes with cost of equity. Now, cost of equity has got multiple models. The most prominent one being the CAPM. Even though it is prominent, there is no problem in this as far as CA interlevel is concerned. Because at CA interlevel, you have your risk-free, you have your beta numbers, you have your RM numbers, you just need to plug into it. You just need to substitute it. Okay. But this is not going to be there way ahead, obviously. So I'm just giving you an idea, students, what is coming up when they reach finals. This particular formula is something, it's quite tricky when it comes to final level. Now for your level, it's pretty easy to implement. So there is nothing tricky in this formula of cost of equity. Now the trick happens when you look at the other formula. So cost of equity is dividend upon P0 or price. That is one formula. So we have one more formula called as earnings per share upon P0. We have one more formula called as D1 upon P0 plus G. Now, if the question is silent about growth, it is quite obvious either of these two formulas is applicable. Right? If the question is specifying which model to use, there's nothing left in it. But if the question is silent about, okay, there is no growth, they're just giving you the dividend and price, use this formula to calculate simply what's the cost of equity. If they are not giving you any amount of dividend, okay, and they are giving you EPS, so you can use this formula. Sometimes the question is not giving you any information, neither EPS, nor price, nor growth, nothing. But they just tell you, the question just tell you that P is, let's say, 8. Now students get confused, sir, there is no cost of capital given to us. How do I calculate the weighted average cost of capital? E is given to you, price to earnings. So we know price to earning is what? MPS, market price per share upon EPS. This is nothing but just the reciprocal of this. So another way of calculating cost of equity is to take reciprocal of P, which is 1 upon 8. That's going to be 12.5% of P. More challenging part is when it comes to this term. Cost of equity equal to D1 upon P0 plus G. The question which most students ask, sir, what should I assume the dividend given to me? Should I assume the dividend to be current year dividend, that is D0, or should I take it as D1? That's a very prominent question which is asked. Now, obviously, the simple thing is, if the question is saying the company paid a dividend, if company has paid a dividend, it means the company which has, it's the current dividend which company has paid. So that's your D0. If the question says the company expects to give a dividend, now if the expectation is coming, that is obviously future. So whenever the question is telling you that future dividend is going to be something, that's obviously your D1. If the question is telling you by some form of language that it is a past dividend, so if it's past dividend, it's going to be D0. Sometimes the question says a current dividend that will be paid at the year end. Now here students get confused, sir. Current dividend is said, and now also they are saying it will be paid at the end of the year. Of course, if the dividend is going to be paid at the end of the year, it's going to be D1. Even though we use the word current dividend or current year dividend to be paid. If it is to be paid, obviously it's going to be D1. Okay. Another challenge is, sir, how to calculate growth rate? Now, students very well understand that simple concept where growth is, B into R, where B is the retention ratio, R is the return on equity. That is very well taken care of. But sometimes this number is not that pretty easy. Sometimes some questions you will find there's nothing mentioned about B and R, retention ratio or return on equity, but they just give you a pattern of prior dividends, right? So they give you like year and the dividend paid. So in year one, let's say the company has paid a dividend of 10 rupees. In second year, it paid a dividend of 11. In third year, it paid a dividend of 12.1. Okay. So these are the areas where students are quite comfortable. So see, there is a growth of 10% every time. So we can assume 10% is a growth rate. But how about a situation where you are given dividend in year 1 was, let's say, 5, and now you have dividend of year 10 as, or maybe dividend of year 9 available to us. Dividend of year 9 is 10. Now how do I calculate the growth rate? Now here you have to simply use your compounding for concept that your D1 will become D2 when there is a growth added to it. Then obviously it keeps on growing. So this is going to be essentially your D2. So of course it is raised to 2. Then the same thing becomes D3. You can definitely say, sir, first year dividend, when it grows for 8 years, it becomes the 9th year dividend. Now you need to solve this because you have D1 value, you have D9 value. Now you just need to solve this, okay, and get the value of the growth rate. So this is where students find it difficult when it comes to the cost of equity calculation, especially the growth rate. So one of the cases we may find this situation. So just be aware of this part, students. It's not that growth is always going to be B into R. The best part is growth rate given to you. Okay, second level of difficulty would be growth rate is not given, but they have given you retention ratio and return on equity. Well, you can calculate that. We can also have a manipulative thing over here where we are just giving you the balance sheet and P&L and ask you to calculate the growth rate. Of course, from that you need to calculate what is the retention ratio, what is the return on equity, and then calculate this. And the most, not difficult, I can say, but the hidden adjustment sort of thing is you have dividend of past given and you are asked to calculate the growth rate. Okay. Then when it comes to weighted average cost of capital, that's pretty simple. You just need to calculate the weights and take the product addition of all of them. Sometimes students get confused by the term called as marginal cost of capital. Sir, we have not learned this. We have learned what is weighted average. What is marginal cost of capital? Of course, you might have learned student marginal costing, marginal production and all such concepts at foundation. We all know marginal is nothing but extra income or extra thing that is being generated, right? So over here, when you say marginal capital, we are talking of the additional capital which you are going to raise in your business. So the additional or extra capital which you are going to raise in your business, that's your marginal capital. So when the question is asking you calculate the marginal cost of capital, remember you need to calculate the cost of only that extra capital. You need not look at what is the other costs or what is your existing cost of capital. That is not relevant. When they are asking marginal, it has to be the marginal cost of capital only. Okay. So I think this is it. One more important point when it comes to cost of capital is, in this formula, redemption value is the final value which the investor gets. In some cases, you may get a convertible debenture or convertible preference share. So in that situation, what should be the redemption value? Sir, in that situation, redemption value, you need to be having the choice now, because since it is a convertible, you've got a choice. Sir, what sort of choice do we have? Choice is simple. Either you can get the debenture redeemed for cash, or you can get the debenture redeemed for shares. As a choice, which one are we going to choose? Of course, wherever the value of the redemption is higher. If you are getting redemption value in form of cash, a higher figure, you definitely take that as a redemption value. But if the cash redemption is just 1,000, but the worth of shares that I'm going to get is 1,600, of course, my redemption value will stand at 1,600. Okay, so just take a note of these few aspects with regards to the cost of capital chapter. Sengupta sir, any specific questions with regard to cost of capital?
Yeah. So there was a question in the May examination, question number 1B. It is said that compute the post-tax cost of debenture using present value. Okay, so what happened that when you're talking about present value, we need to make the trial and error and interpolation, and then we have to find out. Okay, interpolation we can use very well. But however, we have seen many of the examinees, they have used the approximation formula. Okay, so please see that what instruction has been given, and obviously many of the calculation was also wrong. That is another part. So it was a very straightforward question. Present value was given of 10% and 12% also. Interest rate for 1% to 9% also it was given for different combination. So it was only required to apply this. So please be mindful about the which other technique you are going to apply. If there is any specification which is given in the examination, you please follow that. Another problem we see, or many students ask query about, that when to take market price and when to take net proceed. When we can use the net proceed and when we can use the market price. So obviously, if for an example, already issued share is there, then only the market price will be available, or the revised market price will be available. In that case, you can take it, but interchangeably these values can be used. So there was a case scenario question. So if we use the market price, the result will be different, and if we use the net proceed, the result will be different. Now, my dear students, please be very careful when we are talking about the multiple choice question. 4 option is given, and you need to find out the best possible option. Okay, let's say you have used the market price, it didn't match. Now you apply the net proceed, you think it has matched. So you go with that. Whatever the best option available in the MCQ, we need to go for that. Are you getting my point? So please be mindful, because and do not waste too much time that aisa kyun nahi hua, aisa kyun hua. Don't have those things in the examination hall even after coming the examination. So while doing MCQ, one thing please keep in mind that you need to select the best possible option. So this is another example what we have seen in the recent past. Just taking this cue, some of the students, some of the examinees, when they do the case scenario questions or the MCQs, you need to only pick the correct option. So for an example, there is a question of capital budgeting. So all cash flows and everything you are preparing, and then you need to scribble it. You need to calculate it, maybe in a separate rough sheet, and only you need to find the answer. So answering the descriptive question and answering the MCQ question, it's entirely different. And if you don't do that, you will be losing 5 to 10 minutes extra while doing the case scenario question. So case scenario question presentation is not important. Your correct option is important. So please try to save some time, in the while doing the MCQ. At the same time, you should be very, very, concentrated on those, because it's 15 marks and you can fetch 15 out of 15 very, very easily. But don't put too much time on the presentation, writing down the things in detail. If one calculation can be done within, verbally also, you can do that and try to find out the best possible answer in the MCQs. So there, for saving 5-10 minutes, it will really help you to put one extra question, numerical question particular. Otherwise, let's say only 10 minutes, 7 minutes remaining, you need to go for theoretical question only. The last question, question number 4. And there also, while writing down the theoretical question, you should not be writing down essays that you do not know and some generic things you are writing. You cannot be very generic while writing professional examination like chartered accountancy. You need to tell the exact point, exact, things, what are there, maybe very briefly, does not matter. Only point wise you can write. Your answer need not to be lengthy, just point wise, correct point wise. Maybe you can underline a bit, you can write down those answers. That can again fetch some additional marks for you. Now, and always try to attempt all the questions. Not only the full MCQs, but also the full descriptive question. Because if you attempt one additional question of 10 marks, that may fetch you 6, 7, 8 marks, additional marks, which can make a difference. Okay, so these are some of the things which I thought I will share with a cost of capital. Cost of retained earning while calculating personal tax is not required now. We have removed it. Even in the examination, it figure is given. You please ignore that. Okay, that's another area. Still, we are giving the alternative solution if anybody takes it, but better not to take it. Whatever is not there as a rule, we should not be doing in the examination conditions. Carry on, sir, please.
So after this cost of capital, another topic to be discussed is your capital structure. Okay. So in capital structure, broadly, we can say there are two categories of questions or two categories of the sub-chapters we can have. One is called as with regards to capital structure problems, and another area is the capital structure theories. And capital structure problem, one category of questions are pretty simple, where you need to prepare the income statement and simply calculate the EPS or NPS, and whichever is higher, you go ahead with that plan. And one important part that comes in this section is when you want to compute the financial break-even point and the indifference point. The financial break-even point is computed as interest plus preference dividend upon 1 minus P. Right? And then indifference point, we know we calculate the indifference point by equating EPS of one plan with the EPS of another plan. Okay. So now the formula to calculate EPS, that's a standard formula which we use for any plan. You start with EBIT. From that, you're going to subtract the interest, make it as into 1 minus T to make it as after tax, minus preference dividend upon number of equity shares. So you just need to write down the numbers over here, equate both of them and get the value of EBIT. Now understand the concept behind these, both the understanding behind both these points. When you calculate financial break-even point, you're essentially trying to calculate which plan under consideration is having a greater risk and which plan is having a lesser risk. So financial break-even point for whichever plan, if it is higher, it is supposed to be having greater degree of risk. So if the financial break-even point is higher, of course, you are facing a greater degree of risk. And if it is lower, it means you are taking a lower degree of risk. The point of calculating indifference point is you need to be pretty sure where two plans are coinciding with each other. So we know financial indifference point is this point of intersection between both the plans. Now you would have computed the financial break-even point. Financial break-even point means, or the plan, or I can say the financial plan with lower financial break-even point is essentially having lower risk. So wherever you see this particular line, which is growing at a very steady and a slow phase, that's your low risk plan. And this is the high risk plan. This is the high risk plan. So the indifference point essentially tells you that if your financials, if your numbers, if your EBIT numbers are going to be in the lower range, you're going to go for a low risk plan. And if it is in the higher range, then you're going to put it in the high risk phase. Okay, it's simply like, driving a car. You can't drive in city traffic with fourth gear. So you need to be having a lower gear. So when your expected speed is lower, EBIT levels are expected to be lower, you need to be operating at a lower degree of risk, or you will be obviously choosing a plan where there is a lesser risk. But once you cross that threshold, which is your indifference point, now you can definitely take up a higher gear or higher leverage, right? So therefore, this indifference point understands it's not just a number. It's not just a number at which, two plans are having equal EPS. It is a point where two plans are equal to each other, or I can say before that point, one plan is better, and after that point, another plan is better. If your expected EBIT is lesser than this indifference point, then you have this particular portion, which is going to be the low risk plan. And of course, if your expected EBIT or expected operating profit is beyond this indifference point, then you're into that high risk category, or I can say high risk plan can be preferred. So obviously it's a risk appetite, right? How well you're prepared to take the risk. You can take a higher degree of risk when you have a good amount of EBIT or revenue. Till that time, stick to the low risk plan. Okay. So that is with regards to the first part. Then when it comes to the capital structure theories, there is net income approach, net operating income approach, Modigliani Miller with the taxes approach, Modigliani arbitrage and everything. Out of that, net income, net operating income is pretty easy to identify. But when it comes to the capital structure theories, students fail to understand the relevance of model. And just one single line of formula is sufficient for you to solve any formula for or any questions when it comes to model. You just need to remember value of equity is PAT upon K. Value of debt is interest upon KD. Value of firm is EBIT upon KO. But apart from these three basic formula, when it comes to model, because in model, we are bringing in tax into consideration. So there you need to just remember one simple formula. Sir, without taxes, Modigliani and Miller have said that both the firms are going to have same value. But when you have taxes, the levered firm is going to have that upper hand. It's going to save in taxes. So that is going to add to its value. So value of levered firm will be equal to value of unlevered plus the value of debt into the tax rate. So value of levered firm will be equal to value of unlevered plus the value of debt into tax rate. Okay. Just remember this formula. Once you implement this formula, automatically the entire question gets solved easily. Students get stuck. Sir, I have the value of unlevered company. I don't have the cost of capital for levered. I don't have the cost of equity for levered. I don't have the value of levered. How do I solve it? Now the simple idea is just implement this model formula given by Modigliani and Miller. Levered firm is equal to unlevered plus debt into tax. One more query in capital structure which student have is when it comes to arbitrage model. There, investor shifts from undervalued company to an overvalued company. So they sell their shares, they sell their stake in that undervalued company, take the money and invest in the overvalued company. But then one question they arise is, why are we borrowing, sir, when we are going from unlevered company to when we are going from a levered company to an unlevered company investment? So earlier, if the investor was sitting in the levered company and now it wants to go for unlevered, why are we borrowing? Now, obviously, common answer is when you're talking of arbitrage, arbitrage happens when you are getting a higher return with same level of risk. If you are able to generate higher return with higher risk, then it doesn't make any sense for us, right? Or if you're shifting from a high risk proposition to a low risk proposition, then you can't compare the returns. Obviously, if you're moving from a highly levered company, a risky investment, to a relatively less risky investment, the return is definitely going to be lower. If you have taken risk, there you are earning 12%. Now you're going for a lower risk. So of course, the return is going to be lower than 12%. You can't conclude there that there is no arbitrage. If we want to balance both the things, we are going to definitely take a borrowing. Now, borrowings that you're going to undertake, you can't compel the company to take borrowing. You can't just dial up the CEO and say, hey, listen, I'm becoming your investor and I want to see whether I'm getting any additional return or not. Start borrowing now. That is not something which you can't call up, right? So how do we replicate that? How do we replicate the model? The simple replication is, earlier I have invested in a company which had debt. Now I'm going to invest my money in a company which is not having debt. Of course, earlier my investment with regards to proportion of the company was very lower, because if the company was having assets worth 2 lakh, out of which 60,000 was equity and 140 was debt. Okay, so out of this, you are having 10% stake, so which is like 6,000. Okay, so with 6,000 investment, you are owning 10%. Now with the same 6,000 investment, you can't be a same 10% owner in the new company, because there the asset size is large. They don't have any debt. So you need to borrow along with this, maybe along with this 10% you borrow. So maybe 14,000 you're going to borrow. So now you total have 2 lakh. Out of now you're having a total of 20,000. Take this 20,000 and invest in the other company. Now you are matching the risk profile, because there was an indirect loan on you earlier. Now you have a direct loan. And since the risk is matched, now you can compare the returns to check for it. Okay. One pretty common doubt students have is, sir, chalo, agreed that this is 14,000. So total we have got 20,000. Now in the other company is valued at, let's say, 1,90,000. What should I do, sir? Shall I invest this entire 20,000 in this? Shall I invest this entire 20,000? Because if I invest 20,000 in this company, the stake is definitely going to be more than that. You can definitely do that. But an ideal situation would be, as I said, let's make it comparative. So comparative would be like, I was owning 10% of the company earlier. If I'm going to own more than 10% in the other company, of course, the return is likely to be higher. So to match that thing, risk is matched. When we're going to borrow money to match the risk, you can obviously certainly go for matching the percentage stake also. So you will say, okay, out of this 1,90,000, I need 19,000 for investment. So I can at least say this 1,000 I can invest in at least risk-free rate and get some return over and above what I'm getting on this 19,000. Okay, so the surplus money. So when you're shifting from one company to another, ensure that you're matching both the things, the risk as well as the proportion of the investment that we have. Okay. Apart from this, there is also the theoretical aspect to it. Capital structure, there's a theoretical part to it. Of course, this Modigliani Miller, they are very good models. They are Nobel Prize winning models. But these are past. These are past things. So the new upcoming models also we have incorporated in our material, where we have the pecking order theory and other aspects. So where you understand the the mindset of the manager or mindset of the finance manager of raising money, when they are going to go for debt, when they are going to go for retained earnings. So that sequence also needs to be understood by you. So don't be just sticking on to the numericals when it comes to this particular topic, or for that case, any topic in that scenario. Okay. So Sengupta sir, anything?
Two few things, in fact, very nicely explained. Once, you were talking about the traffic, city traffic and outside traffic, how to increase the speed and how to decrease the speed. Very, very important point. There are two concepts in capital structure related to leverage, also related to overall capital structure. One is trading on equity, that how we can play on equity, reducing the equity, giving the maximum percentage of or maximum EPS to them, go for maximum debt, reduce the equity, and then play for it. But you can play for it once when the things are favorable to you. So in the city, when the things are not in your favor, what sir has mentioned, you cannot really play with your equity. And sometimes it can be like a coalition government. We used to see the coalition government earlier. Probably you all were very young that time. 5, 6 parties coming together and forming a government, because debt will have their say, bankers will have their say, financial institution can play a role. So really the full control mechanism may not be working in that case when the equity percentage is very low, though you can maximize the earning per share if your return is good. So trading on equity, this is one area. Again, you should understand, you should see. Second is, financial leverage. When you are talking about, in case of capital structure, when you are depending too much on debt, it can work as double-edged sword. That means it can increase your earning per share, but if your things are not going well, then it may really affect your organization very, very negatively. Financially, you'll be under distress. Long time, if you are under distress, it will become insolvent, and all those problems will be there. So need to be very, very careful about using the debt. Yes, tax leverage will be there, tax benefit will be there, tax shield will be there. You can maximize the earning per share, but need to be very, very careful that how much to use and when to use. Second part, the theoretical question, what sir has mentioned. So this numerical NI approach, NOI approach, traditional approach, and mainly the numerical of Modigliani-Miller with tax and without tax. So these are the numerical part. Then which option is better? When the EPS will be maximum, that option will be better. And generally you will see that if your return is more than your cost of capital, where the debt is maximum, that there you will be getting maximum EPS. So that we all understand. In the theoretical question, last time also there was a theoretical question. I can read out exactly. Hypothesis of dividend policy. This was of dividend policy, but this can be there in capital structure also. No, this was approach. So approach of dividend policy and approach of capital structure, both are having certain assumptions. Like perfect market, information will be passed on. Please, there are 3-4 normal assumptions are there. Please also go through that. Maybe you can write down one line about that. So many of the students who could not attempt the full question also could not attempt this question. So that should not be, because it's a very basic things and very easily you can cover it. So query was some of the query was regarding the arbitrage. I think arbitrage process has been very well explained, and mind you, till the time there will be benefit of switching from one company to another company, it will work. The moment arbitrage will stop, when that shifting will not give you any benefit. I think sir has explained that. There is an example in the study material also. You please go through that. So financial arbitrage is another very, very important concept which you need to understand. Levered form, unlevered form, the valuation, sir has explained. So all these things, as far as the numerical is concerned, calculation of indifference point, EBIT where EPS will be same. Okay, so these are some of the things which I think we need to be careful while doing the examination. Some people are saying, some students are saying, they are able to solve the practical question only after seeing the solution. That means your concepts are not good. Only seeing the solution is not going to solve anything. That's not solution at all. So you need to clear your concept. Maybe illustration you can go through, but when you will be doing the solution, it has to be without seeing the solution. It cannot be auditing the solution, that kaise hua, kyun hua, etc. But you need to solve in your own hand. You need to practice, and then only you will be able to find out that where you are doing wrong. So capital structure very, very important. Sometimes case scenario comes, sometimes main comes. How to manage time for both the section and how to attempt paper, which section should, okay, means between financial management and strategic management. It depends on you, but financial management in general requires little bit more time because it's numerical based. So accordingly, you must prepare, and it can fetch you very good marks also, because case scenario, 15 marks, if you can fetch 15 out of 15, then there are 3 numerical question. First question, 5 into 3, that if you can get that 15, so 30 marks, and then out of 20, maybe another 10 or so. So from the financial management itself, you can fetch around 40, 45 marks. So that will be a very good marks overall in the subject of financial management and strategic management. Taking a little bit further, sir, kindly permit a few more things. Leverage, I told you that computation step, sometime in case of leverage, this I am talking about the last examination. So a lot of time computation steps, there are mistakes in that. Sometimes rounding of figures, sometimes taking the salvage value, sometimes the calculation errors. These are using wrong technique, ignoring the preference dividend figures. So these are some of the common observation what we have seen in the theoretical part, not aware about the theoretical aspect, like pecking order, sir has mentioned. I do not know how many of you are aware about that. If you're not aware, you please go through Linter's model. Everything is given in the study material. You need to prepare your own notes, and whatever comes, you should be able to reply. Just to add 1 or 2 more things from my side. Sequence of income statement while calculating EPS when the preference share is there. So sequence is PAT, then preference dividend, then earnings available to equity shareholders. So PAT is available to both preference as well as equity shareholder. First, you need to give preference dividend, balance whatever is remaining, you need to give it to the equity shareholder. So please, understand that logical sequence of giving the things. Okay. This much we have discussed. Capital structure, assumptions. I told you already that please remember assumption. 3-4 basic points are there. But if you are able to understand that, able to write that, that will be very good. Sometimes limitation, 1 or 2 limitation, and answer writing techniques you need to improve in the theoretical question. Point wise, very precise, very brief, and very clear examination you need to write down while writing the answers of the theoretical questions. So these were some of the points. This we have done the analysis of what we have done, what you have done in the examination, and some of your questions. So combining all these things together, what sir has said, this is about capital structure, leverage, cost of capital, ratio analysis. This much we have covered. Sir, please proceed further.
So after this, a connected topic which we have, that's your dividend decisions. So when it comes to dividend decisions, we essentially have the again theories of relevance and theories of irrelevance. Okay, there are certain theories which are relevant. There are certain theories which are talking of irrelevant nature of dividend. Again, this is a pretty easy chapter where it is bound by a few formulae. So it starts with your Gordon, then you have Walter, right? And then again we have our favorite duo, Modigliani Miller. So these two guys are extremely contributed to the finance profile. So Modigliani Miller, we are very grateful for them. So wherever we have these concepts,
both have got Nobel Prize. In fact,
yeah, both have got
Modigliani and Miller,
Nobel Prize,
and
yes.
they have contributed a lot And students may understand they are traveling you people, but they have contributed in the field of finance a lot.
Yeah,
on
they have
lighter side.
contributed a lot. I mean, their models are still used by, iconic valuation experts, including our dear Ashwath Damodaran, right? So these are they're very much contributory in nature. And of course, we need to be having a good amount of respect for these people. So we have essentially three models, especially Gordon, Walter, and Modigliani model, out of which students are pretty comfortable with Gordon and Walter because it's just substitution and bit of analysis. But when it comes to Modigliani Miller, it's a process. It follows a process as to why the value of the company is going to remain same if the company pays dividend, and even if the company doesn't pay dividend, why it is remaining same. So the simple understanding that you need to have, students, is in this Modigliani Miller model, we are simply assuming that there is no source of debt, because any theory can be understood only when you have certain assumptions. In the absence of any assumptions, sorry, but you can't be proving any theory. All your scientific theories are also working, they are also subject to good degree of assumption. So over here also the assumptions are going to be pretty much there, that you're going to raise money by way of equity only. Because if you don't follow that assumption, the value of a company may get affected by the amount of debt that you're raising. Right. So the simple thing is, if you're paying dividend, the conclusion that Modigliani Miller says is, if you're paying dividend, uh, of course, that dividend needs to be coming from your reserves. So, of course, if you're paying out reserves, by way of dividend, you will have less capital available for future investments. So, when you're planning for future investments, if you're having less capital, you're going to issue more shares. And if you're going to issue more shares, the value of your shares is going to be lower, right? And of course, the number of shares is going to be higher, right? So that both of them actually balance out each other. Apart from this simple equations, we do have other models of dividend also, where you have the Lindner's model, where you have the traditional Graham and Dodd model. Those models are used for Lindner model is used to estimate what should be the next year dividend. Okay, so it's a guiding principle for that. Graham and Dodd, they have not come up with any mathematical, way of deriving the valuation numbers. Gordon, Walter, and Modigliani, they all are giving their mathematical justification for why the company value is going to change or why the company value is going to remain constant. But these two people, Graham and Dodd, they have not done that. They have done something called as empirical analysis. So empirical analysis is basically based on historical data, based on ongoing data, what valuation rule can be set. So overall, this is a pretty simple chapter and easy to score. I don't think there is anything apart from this points of discussion in the dividend decision. Just be careful of the theoretical aspects, because when you want to pay dividend, you don't really, finance manager don't really open up the theories given by Modigliani or Graham and Dodd and see what are the assumptions they are saying, because we need to operate in real life situations. So those real life situations also you need to be aware of. So if I ask you, let's say a company is having a good growth prospect, it's a new startup company, should it pay dividend or not? Obvious business decision would be, since it's a startup company, it will be anyways having a scarcity of capital. If it is just going to pay out dividend, there's going to be a fund crunch for them. So there you need to understand, since it's a startup company, since it's a growing company, it needs money for growth. It will be obviously discouraged from giving any amount of dividends. Okay, so that is about this dividend decision theory. Anything with regards to this, sir? Any query, student query with regards to this topic?
Not specific. I think we have covered in the earlier part also that, and particularly the situation, what Walter and Gordon says, how much dividend, what is the dividend percentage which is optimum, when the value will be maximum, when the return is more than cost of capital. All those things you just prepare your own notes and you try to understand. And approach, obviously, how much new share to be issued. So there are questions in the study material also. So that is one point you need to understand. And when you will be taking that, you will be calculating how much new share to be issued. You take the market price of share into consideration. at that point of time. Carry on, sir.
Then after this, the most important topic, which is investment decisions. Investment decisions. We know this topic, investment decision, also called as capital budgeting. This is something very challenging for quite a few students, because this is essentially the topic where you can expect the question itself to be of case-based. Like in other topics, you may have a smaller question, but when it comes to investment decisions, the question itself could be a case-based. You need to consider multiple factors together. So first and foremost that you need to take care when you're solving this type of questions is read the question very carefully. Because what happens is students keep on, quickly reading these questions, and then they skip one of the few facts. So primarily investment decisions are supposed to calculate NPV or are supposed to calculate IRR. The most crucial part or the initial part on which you are going to focus in investment decisions is to calculate the cash flows. You need to understand that cash flows are supposed to be after tax. The cash flow should be something which is incremental in nature. You should not be considering the sunk cost or the research cost already incurred. So all those smaller points need to be considered. So certain problems that the students have is calculating of cash flows is they ignore these very factual numbers, that there is some extra cost which company is going to have. Extra cost can be in the form of some machinery being purchased, so that's a cash outflow. Savings in the depreciation, after tax savings in depreciation. Then in this investment decision, one prominent problem which students face is while solving, they don't have any structure in mind. Okay, so it's first important for the students to have a proper structure. Remember, your first step to solve investment decision questions would be to calculate the cash flow every year. Now that cash flow can be cash flow from your operations. Those that cash flows can be cash flow coming in from the new investments coming in, or payment of any expense. Or you also need to be careful of if there is any income which was coming earlier but now it is not coming. You need to account that for as a additional cost. So you need to do all the calculations with incremental perspective or incremental approach. Okay. So with that incremental approach only you can tackle these type of questions. Apart from that, students are very well good to do to calculate the present value. In fact, we anyways give the present value factors in the question. So they're good with the calculation part. So calculation is not something where they're facing the problem. The challenge is interpreting the question. And the first step to interpret the question in an effective way is to simply read the question carefully. Remember, or I can say highlight those facts which are relevant for the question and not to skip any single line of information. Because if you are going to miss one single line of information, the entire question goes wrong and all your cash flow calculation, NPV calculation goes for a toss. Okay. So this investment decisions topic, calculation, you're very good at, students, but what you're going to face problem is with regards to the interpretation. And the first step, as I said, read the question carefully, note down the important points that are happening in it, note down the important information that are there, which are, just think, is this information going to provide any extra cash? Is it going to result in any additional cash inflow or additional cash outflow? Just focus on that part. So once you are focused on that very much particular part, I'm pretty sure you will be in a very good position to solve any sort of these investment decision questions. Because calculation, as I said, calculating IRR, NPV, all those things are very well. But then you should not be focused, you should not be looking at the very important part. Because see, students, after you qualify, when you enter the corporate world, you're not supposed to be doing the calculations. Right? Your calculations, we have computers, we have servers, now we have artificial intelligence also. But what should be the primary focus area is understanding the situation and formulating the problem accordingly. Okay. sometimes, students get confused between IRR and MIRR. Any student says, sir, MIRR is same as IRR. Sometimes students say, I solved it, sir. Question, I solved IRR, but I don't know what was that M. Maybe that was a misprint. No, it's not a misprint, students. It's MIRR means it's a modified internal rate of return. It's a proper number. It's a proper special type of IRR which is calculated. Remember, IRR is calculated under a presumption that money which you are getting, the cash flow which you are getting, that's getting reinvested. But when it comes to MIRR, you are saying that you're not going to reinvest it. Rather, you are going, you're not going to reinvest in the business itself, in the project itself. Rather, you are going to reinvest it at a particular cutoff rate. That cutoff rate could be mostly your cost of capital. Okay, so just be aware of those few nitty-gritties when it comes to the investment decisions.
Just to add what sir has said, that some of the common error what we have seen in last few examination is calculation of present value of salvage, scrap value, and the annual cash inflow. So if you are not taking the salvage value or the scrap value in the correct way, particularly when that inflow will come, and then taking the present value of that can result into an error. Then second thing is PI and equivalent annualized NPV figure. Sometimes you are unable to calculate. This time also there was a question of calculating equivalent annualized NPV. So that has not been calculated correctly. New adjustment, if there is anything like subsidy, for an example, there was a question 1 or 2 years back. So what sir has said, you just try to understand each and every adjustment either as a cash inflow or cash outflow. If it does not affect your inflow or outflow, it does not make any impact on you as far as the capital budgeting is concerned. There are varieties of type of questions which can come in capital budgeting, and your conceptual understanding should be very, very strong. And again, mugging up of formulas of internal rate of return, PI, NPV is not going to help. You need to understand the meaning of the question, what they want, and you need to practice the array of questions. One of the students was saying that, sometimes he is able to solve the questions, but while giving the examination, he is unable to solve it. That means there is a lack of practice. So you need to practice those questions again and again and again and again, and need to understand that why this step has come. So when you will be solving a question yourself, then only you will need to, and you will be able to understand that where you have gone wrong or where you are going wrong, and where there are mistakes. Just taking this opportunity, one more question that was of capital structure, which was there in case scenario 1, XYZ Limited, in the May examination. The question was talking about what is the equity share capital outstanding before the additional fund is introduced. So we got the equity share holder fund of 1.50 crore. Okay, but there was also a retained earning of 50 lakh which was given. Okay, so many of you have marked 1.5 crore. That 1.5 crore is the equity shareholder fund. Fund includes the previous year retained earning, reserve and surplus, etc., etc. So equity share capital will be 1.5 crore minus 50 lakh. That is 1 crore. So many of you have probably gone wrong in this. So this kind of small things, you should be very, very careful. This is I'm talking about the question of the last term, that was May 2026 question. Over to you, sir.
Okay. So then the last topic which we will be looking at is now the working capital. So working capital, broadly, it has got one set of concept called as estimation of working capital. Second is the debtors or receivables management. Then you have the cash management. In case of estimation, when you're looking for estimation of working capital, again, students find it difficult, sir. How do we apply which particular formula? So that estimation is something that's challenging. So I generally recommend students to follow a two-step approach. The two-step approach is, first, get the balance sheet or get the P&L numbers, the cost structure very clear. What's your raw material cost? What's your labor cost? What's your admin cost? All those things needs to be properly, tabulated so that you have the ready-made numbers with you. And then you go ahead with the estimation part. Now, one type of typical question where students face difficulty is when a company which was earlier operating under single shift, now when it is going for a double shift, then what will happen to the operating cycle of previous year? Of course, the operating cycle are going to remain same, but then the student changes, sir, if the shift is doubled, the operating cycle will also double. But it's not that case, right? So I simply would like to say that if the number of family members increase, okay, so let's say students, you're joined by new family members, maybe coming from your native place. So if it is your policy that you want to keep food grains for 3 months at home as a stored value, of course, even after new family members coming in, you will still have 3 months. But the point is the consumption which you had in 3 months earlier, let's say earlier you had 3 family members. Now you are having 6 family members. Now the consumption of these 3 family members is not going to be same as the 6 family members. But if it's like 3 family members and each one of them consume, let's say 100 kgs, right? So you have a policy that 300 is your annual consumption. So to that you will apply 3 by 12, which is 3 months policy. Now if you have 6, of course the consumption is also increased, but your policy will still remain like 3 by 12. So when the shift is happening, double shift or triple shift is happening, then remember the operating cycles are going to be same because your cost structure has definitely improved. But one important operating cycle is going to definitely change, and that is your conversion, WIP conversion cycle. Because since instead of 8 hours, now you're going to operate, let's say 16 hours. So instead of 8 hours, if you're going to operate 16 hours, of course, you will be able to complete that job in half of the time. Right? So for example, one building construction required a year. But now if you're going to, have your workers doubled or maybe shift of workers getting doubled, you can get the same building constructed within 6 months. That same logic is going to be applied over here. So this is where the students find it confusing. Why the other operating cycles are remaining same, but this conversion cycle or WIP conversion cycle is getting half. That's one important area. Another important aspect is when it comes to estimation, what should be the proportion of raw material, labor and overheads we should have. So the proportion is similarly like, if it is raw material needs to be taken as 100% for WIP. If nothing is mentioned, you can definitely take 50% of labor and overheads. But if the question is clearly stating you to take certain percentage or certain number, you need to be following that. Then coming to the debtors management, the typical type of questions that we have is to select a particular debtors plan. Of course, over there you calculate the net benefit that the company is getting by giving any sort of debt. We need to also be asking the students to please focus on the factoring part. Okay, so factoring is not something, it is optional, because factoring, they say, most of the people say that factoring is not so relevant nowadays, but it's not that case. There is definitely some amount of relevance, and you need to be very good at calculating how the factoring is done. Understand, factoring is not only giving the collection right to the factor. You're not giving the power to the factor just to collect money on your behalf. The factor is going to provide you finance as an upfront payment. So as an upfront payment, that factor is going to obviously charge you interest. Because questions, students ask, sir, factor is already taking commission. Why is he charging us interest? Because he's going to provide you fund beforehand. So that's the reason factor is providing you, factor is going to charge you an interest for the financing part. And cash management is pretty simple because you have preparation of your cash budget, which is similar to your cash receipt and payment. Just be cautious enough, student, that don't take any accrual item into your cash receipt or payment, because that will obviously destroy your entire cash budget. So while preparing cash budget, be sure that you're converting everything in form of cash receipts and payments. And secondly, these cash management models, you have Miller or you have the Baumol model, which are for effective cash management. It will tell you like what should be the ideal level of cash that you should have, or when should you be withdrawing the cash. So all those aspects are typically there over here. And important part, one more with debtors and creditors management is calculation of the cost of capital. Because here, when you are going to collect money from debtors early by giving them discount, that is essentially like a cost. So you need to be well aware of how to calculate that cost so that you can compare that cost with that of the market rate or with that of the banker's interest and then take a appropriate informed decision. Okay. Yeah. Sengupta sir, anything? This
I think, working capital, as I told you in the very beginning, that very, very important chapter that, either the case scenario question comes or descriptive questions come, because working capital, it's the one topic, but it has multiple areas like calculation of operating cycle, I told you, then working capital requirement, then some of the questions where the factoring will come into play, receivable management, then payable management, then various cash model. So calculation is again very, very important. And again, there is no formula as such. You just need to practice varieties of questions, some double shift questions, working in double shift. So that kind of questions also is there. So various type of questions you need to practice, and not only the study material illustrations, but back exercises, previous year questions. So multiple areas of questions you need to practice. And we have seen, some errors in this particular chapter also in the last few examination. In fact, in the cash management, there was a question number 3B, operating cash cycle computation. So cash days calculation, cash cycle days calculation was wrong in many of the cases. And when your initial step will be incorrect, your subsequent steps also will be incorrect. So probably some people could prepare it partially, some found it very difficult to complete as a whole. So this was one area. Then sometimes the theoretical question, small theoretical question also. Sometimes the cash model like OR model or Baumol model, or what is working capital or working capital requirement, positive working capital, negative working capital. So those kind of questions are there. Factoring, what is the meaning of factoring? What is the advantage, disadvantages? So you should have a complete preparation of the chapter, not only the numericals, many numerical part is there, but also theoretical part. And before we finish, some of the things I will request you to avoid. This I have noted, I prepared based on some of your performance, some of this performance, real performance of the students or examinees. Incorrect initiation lead to cascading errors. I told you already. So when you're starting the question, like, when you are driving a car or scooter or bicycle, slowly we increase the speed. So the starting point should be very, very careful. Your initial calculation, then it will go in a flow. So that part you please take care. I told you that use only appropriate time in the case scenario questions. Don't try to devote too much time on the case scenario question itself. Don't worry about the presentation, only worry about the selecting the correct option. That is number 2. Read the question very carefully using approximation instead of PV, present value. Obviously, you cannot do that, but it was done by many of you. Leaving multi-step numerical question where there are long steps. You are, let's say, redeemable debenture, you are calculating the cost of redeemable debenture. Redeemable. So there are multiple steps. You cannot leave in between. Carry on, solve the question, that will fetch you more marks. Similar concepts, if the sources of finance, there are similar concept, you should have a clarity what exactly it means. So you should be knowing what is bridge finance, you should be knowing what is angel finance. Okay. Then proper answer format and support working, particularly in the numerical question, all the question can be solved in a specified way, including capital budgeting. You try to follow that, and you should show the working wherever it is required. Wherever it is not required, you may not be showing it, but you supplement, because working also may have numbers allocated to them. So you will be losing marks if you don't show it. You may be very good in practical question, but don't ignore theory. Give importance to the theoretical part. It can be a savior if the time comes. Then computation errors, rounding off. Generally, we take 2-digit figure, and too many rounding off figures, without taking even the 2-digit, or you are taking 4-5 digit, there may be, calculation error. So stick to that, and accordingly you may go with your calculation. While writing down the theoretical questions, what you can do, you can write down, you can underline the keywords. Whatever the keywords are there, you may underline one word in each sentence, and try to be very precise, very, very careful. You need to draw the attention of the examiners who are evaluating. You need to tell them, see sir or ma'am, I have done it correctly, and this is the way I have written. It should be very attractive, it should be very easy to understand. So that will be very, very helpful. And your conceptual understanding in this subject, as I told you, is very, very important. And if you understand the concept, starting from almost all chapter we have discussed today, if you understand the concept and practice all the questions, plus the previous year RTPs, MTPs, past year questions, and give mock test paper, I think Jagbandhu sir will agree with me. Appearing in mock test paper and then seeing the solution and making probably an error book where you will be writing down where you are going wrong, I think that will give you a lot of improvement. So if you appear in 5 mock test paper in one subject, it may be a previous year question paper, it may be a previous year mock test paper, it may be anything. But if you appear in that, your difference will be very significant from the first test to the last test. That I think Jagbandhu sir and myself can guarantee you, that if you give the mock test, giving is not important, but analyzing is more important. That where you are doing mistakes, where you need to improve, where you need to improve your presentation, where you feel your concepts are weak, go back to the drawing room, go back to the working table or your reading table, and work on those areas and come back and try to improve in the next test. There will be a lot of differences. Even if you are, let's say, comfortable in a subject of 50-60%, you feel you are comfortable, mock test can take you to 80% or 90%. I am a firm believer of that. I think sir also will agree that practice by hand, reading will not help. Write, and practice, and practice. So that will give you an improvement. Find out your own errors, your own limitations, and try to improve on that. Anything, if you feel that you are not good, you need to work on that. I can give you an example of, short ball. Many of the Indian players, Shreyas Iyer for an example, I do not know, he is not playing well or not at this moment of time, but he was very weak in short ball. He practiced. Now he is one of the strongest players. There are many other players. Earlier, Sourav Ganguly used to be there, who was very weak in, this kind of things, short ball. But they have conquered those areas. So many of these great people, they had their weaknesses, but they have improved on their weaknesses. They've improved their skill, and they have conquered what they wanted. I'm sure if you have any weakness, I'm sure with your lot of practice, with your understanding, with your practice, with your clarity, practicing the past year paper, suggested answer, you can do wonders. And this subject, I don't think we'll have any problem in this subject at all. So that's my, we are always there. If there is any query, sir is also taking session, already recorded lectures are there. We are always there. fm-inter@ici.in is the email ID. You can send your query whenever you want. We'll be there for your service. Sir, any final thought from your side?
Yeah, so as I think the final thought has already been reiterated by you, sir. The thing is that getting the conceptual clarity is foremost important, and the second thing would be to practice the questions. The only two ways that we can tackle any, not only FM, I can say for any subject of, or ICA, I can say, getting the conceptual clarity, you can't be beating around the bush when you are writing any conceptual answers. You need to be very
Right.
clear about what you're writing. You need to be very to the point when it comes to any conceptual answer or any theoretical answer. For questions, practical problems, you need to practice. Unless and until you practice, you won't be in a position to interpret a question and solve it.
Right, right. So thank you, sir, for taking this session. And thank you all the students for being attentive, for attending this particular session. We understand that a lot of you are having your questions. We have tried our level best to answer each and every query. Two final thought. Number one, all topics are important, because many of you ask that, sir, which topic is important? All topics are important. No selective study, please. Because sometimes what happens, let's say you have not practiced a capital structure. Very easy question come from capital structure. You have practiced a lot of question from leverage, but there may be a difficult question of leverage. Though I don't think any difficult question can be there in any of these topics. All topics are manageable. All topics are very simple and very easily you can solve. So again, conceptual clarity and practice, these are the two things, two mantra based on which you can conquer this examination very well. On behalf of sir and on my behalf, on behalf of Board of Studies Academic, we'd like to thank all of you for attending this session. Thank you very much.